you will finally understand how to combine ICT and SMC concepts to get the sniper entry after watching this video. I'm gonna simplify both concepts in a way that even a 10-year-old kid can understand. I pretty much use this strategy every single day, so you guys can see in my trade breakdowns I'm using this consistently. So without further ado, ready to lock in, let's get to the charts. Okay, let's talk about what is the fair value gap first. The fair value gap, one of the biggest concepts in the trading space right now. But not all fair value gaps are created equal. In fact, most traders fail because they treat every fair value gap like a buy or a sell signal. Take a look at these two. This one got stopped out completely, but this one it hit the take profit target perfectly. The question is why? First, the basis. And fair value gap happens when price moves so fast it creates an imbalance. It's a 3 candle pattern where the wick of candle 1 and the wick of candle 3 don't touch. Think of it as a liquidity void. Price moves so fast that sellers didn't get a chance to participate. Naturally, the market wants to return to this zone to fill those orders. You mark it by connecting the previous candle's high to the following candle's low. Simple, right? But if you have traded these for more than a day, you know they end 100%. So how do we tell the winners from the losers? There are actually 5 key factors that must be true for a fair value gap to be high probability. The first and most important is that the fair value gap must be verging. Think about it. The whole point for a fair value gap is that price moves so fast that the other side couldn't react, right? For the setup toward that zone must remain and tested. Look at this example right here. Right after the fair value gap was created, price dipped back into it immediately before continuing its move. If price returned to this zone a second time, it's no longer valid. Why? Because the market already spent the night there. It's been fucked. So it's not a virgin anymore. I'm talking about the market. To be a valid entry for us, the fair value gap must be fresh and untouched. If it's already been tested, it's off the list. Now let's move on to the point number 2, the verdict of the close. You have to watch how the candle reacts inside the fair value gap area. If the candle breaks through the zone and closes completely outside of it, like this, the gap is dead. It's invalid. Do not enter, do not take any trades. The market just overrule your setup. It is okay if a wick goes with the fair value gap as long as the body closes inside the box. The fair value gap is still good for an entry. If the body stays inside, we are safe. Now let's talk about the factor number 3. Add in other levels like support and resistance. Look at this chart. We have a bullish fair value gap, but we also have support right in the middle. When a fair value gap and a support level are in the same place, the trade is much stronger. For a bearish fair value gap, we want to find a resistance level inside the zone. This makes your fair value gaps work much better. Now moving on to factor number 4, priority. Not all fair value gaps carry the same weight. If you see multiple zones on your screen, you need to know which one the market actually cares about. In a bullish trend, you will often see several fair value gaps stacked up. Here's the rule. The lowest fair value gap always has the highest priority. Is the strongest level on the chart. The higher fair value gaps are often just B bumps. They are the weakest. In a perfect scenario, you want to wait for price to return to the deepest discount possible before you judge the entry. It's the same for bearish setups. If you have multiple fair value gaps, the highest one, the one farthest from current price, is your high probability zone. This is where the big players are looking to sell. Think of it like a sale at a store. You don't want to buy at a fast small discount. You want the clearance section at the bottom. Now let's move on to factor number 5. This is the deal breaker, the break-off stretcher. Without this, a fair value gap is just noise on the chart. Look at this move. Price created a clean fair value gap, but it failed to break the previous high. Because the stretcher stayed intact, the bulls never actually took control. We do not trade this kind of fair value gap. Now look at this. Price aggressively breaks the previous high. That's our break-off stretcher. In the process, it leaves a gap behind. This fair value gap is now high probability because it has the momentum of a stretcher shift behind it. The same applies to shorts. You want to see price smash through the previous low before or during the creation of the fair value gap. This confirms the sellers are officially in church. A break-off stretcher is the market's way of showing its turn. When you combine an untouched zone, a strong candle close, and a stretch or a break, you aren't just guessing anymore. You are trading with the trend. If you ignore break-off stretcher, you're just gambling. But if you combine all 5 of these factors, you create the ultimate fair value gap setup. Let's look at a live trade example on how I combine fair value gap for an entry and a breakout stretch chart for a confirmation. Okay, this is the USD chart on the 4-hour time frame. I mark out all of those fair value gaps area, and as soon as the price touched this fair value gap area and took out all of those orders within the gap, I drop down to the 15-minute chart to see if we have any breakout stretch chart to the upside. As soon as price came back to this breakout stretch chart area in the pre-London session, I took a buy. This is what we call a sniper entry. Now look at this trade right here. These are the fair value gaps area in the 4-hour time frame. As you can see, I didn't take this trade right here because it has been touched multiple times, and we have more chance that these fair value gaps wouldn't work out. So I waited until price touched this area. As soon as price came back into this fair value gap area, and after it took out all of those orders in this area, I drop down to the 15-minute chart and see if we have breakout stretch chart to the upside. As soon as I saw this breakout stretch chart to the upside, I took a buy. Now let's look at another trade for a sell. This is the 4-hour gold chart. There are 3 fair value gaps area right here. So the question is, which one is the strongest? The one furthest from the current price, right? But you can wait every time to get the best confirmation so that you can trade the furthest fair value gap area. So as soon as the price has touched this first fair value gap area, I waited until breakout stretch chart happens in the New York session. But as you can see, nothing happened. Since I don't trade Asian session where there is no volume, in the next day I look at the price and this fair value gap was invalid because this candle in Asian session just breaks above this fair value gap area and closed above it. So I waited another fair value gap area and waited until London session to see if we have breakout stretch chart to the downside in the 15-minute time frame. As soon as I saw the breakout stretch chart to the downside in the 15-minute time frame, I took a sell. This is it, man. This is how you combine ICT and SMC concepts to get the sniper entry. And this is exactly how I find those sniper entries, by combining ICT and SMC concepts. Just remember these 3 steps. Number 1, find your fair value gap on the 4-hour chart. Number 2, wait for the price to tap into that area and grab the orders. Number 3, drop to the 15-minute time frame and look for that breakout stretch chart to confirm the move. If you don't see breakout stretch chart, you don't take the trade. It's all about being patient and waiting for the right time, especially during the London and the New York session. If this video helped you understand how to combine ICT and SMC concepts to get the sniper entry, hit that like button and subscribe to the channel for more simple trading setups. Leave a comment below if you have any questions. I'll see you in the next video. Ciao, ciao.